My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com. Not to chase maximizing your gains, because if you do maximize your gains without taking into account minimizing the tail risk, then you're always going to be at the whim of the market. And if the market's going up, then you're going to be doing well. But if the market pulls back, and there's a saying that the bull takes the stairs up, but the bear jumps out the window, you need to make sure that at all times you're protected against the bear jumping out the window. And you don't want to lose all of your hard-earned gains if the market has like a March 2020, because in March 2020, when the market fell, I think like 36% in 33 days, many people were forced to close out their positions, only to then see the market rebound and recoup all of its losses in just like 2 months. But if you were forced to close out those positions because you traded too large, then that rebound is not going to help you. So slow and steady is extremely, extremely important.
Yeah, and you bring up a bunch of good points. I agree with you specifically on the idea of managing risk via size. I do think traders get too wrapped up in this idea of hedging, and they're afraid of variance and they're afraid of risk. And I think that a lot of times comes to their own detriment. Like when I was going through the phase of aggressively growing my portfolio, I was very frequently levered, like naked levered, where if the market took a crap, I would have been in huge, huge trouble if I did nothing. But that's kind of the beauty of trading options, is when we would inevitably get these kinds of down moves, there's so many products and so many ways that we can start offsetting risk very quickly once it starts hitting metrics. So I agree with you there, specifically on the idea of controlling risk. And even if you're levered, right, you can't be levered without controlling risk. Otherwise, you are going to blow up. It is literally just a matter of time before a move happens that you're not ready for. And then you are in a giant, giant problem. One of the things I wanted to ask you is, you were saying that you were hedging your portfolio with SPX puts. And I'm curious, why do you use that as compared to something like VIX or like VIX futures or something?
I primarily like SPX because it offsets some of the 0 and 1 DTE trades that I make. So from a portfolio margin perspective, it does help with that. Additionally, with VIX, because from my understanding of VIX, it's essentially like a math equation where you know that if VIX is trading at 30, then it's only a matter of time where it's going to then contract and there's going to be a volatility crush more so to the mean. One part of my strategy, which I really like doing, is when VIX is trading over 30, I will sell calls on VIX with, a 30 to 60 day or even 90-day expiration. But in general, I prefer buying the SPX long dated options just because it's something that, one, there's a lot of liquidity. Also, you can go as far as like 5 years out. And it's just something that I feel comfortable with. I've been doing it for a while, and maybe it's just a habit. But you can definitely hedge with VIX as well, but also remember that when you're buying those puts in SPX, there is obviously like a large VIX component because the option pricing is going to be factored in, and the VIX measures the volatility on the SPX. So whether you're hedging with VIX or you're hedging with SPX or SPY, it's extremely highly correlated.
Yeah, definitely. And that's actually why I bring it up, because for people that are buying really long-term protection, against the portfolio, if you're beta weighting your deltas, going with volatility, a lot of times, again, to your point, if the VIX is elevated, it's not a great time. You're already too late. But if the VIX is not elevated at that point, it's actually, I would say, a more efficient trade than going with long SPX puts. And it's specifically because if you buy SPX puts, let's say, SPX is trading at 43.87 right now. And let's say over the next 4 months, it trends up, it trends up, it trends up, it trends up. Now the deductible on your puts it's now massive
Mhm.
because the distance between where you entered and where it is now is very different. Whereas that's kind of the beauty if you use VIX volatility of some sort, if you're beta weighting your deltas, because as you know, if you get in when VIX is 15, if the market trends up, trends up, trends up, the VIX is still at 15, maybe
Right,
14, maybe 13.
right. Yeah, there's
And
always
whenever,
going to be a floor, especially
exactly.
like
Yeah. So
maybe
you,
the floor is going to be like around 12. I mean, I've heard the VIX has gone below 10, but it's never there for an extended period of time.
yep, exactly. And so it's just, I found that that actually adds a lot of efficiency behind the hedge because then you don't have to keep sliding it up and eating a loss in order to maintain your deductible on the puts, especially if they're longer term. So yeah, just throwing, ideas out there because I tested both of them pretty extensively. And in general, I actually really prefer the VIX. Yeah,
So
using VIX futures.
okay, so VIX futures, and you would prefer VIX futures as opposed to buying long dated VIX calls, like in the money calls?
You do either. Yeah, I would argue either is completely fine. It really just comes down to the size that you're trading and what kind of protection you're wanting to outlay for. And I
Mhm.
also one of the other things that I do talk to people about if we do use VIX options, specifically calls, is you can even enhance your risk profile pretty significantly. If you start with in the money calls, to your point, that will provide the primary hedge, but that you can add some teeny options, some kickers that are really far out of the money. They're low extrinsic value anyways, right? So theta decay is going to be inherently slower no matter what, days to expiration and being far out of the money. But then those can compound really quickly and they can actually pay out like pretty damn nice in a big pullback. So yeah, I think
So,
combining both of those is actually really slick.
so I'm assuming like those out of the money VIX calls, then they would essentially act as like lottery tickets. Is that correct?
Yeah, it's. I guess it depends on what we mean by lottery tickets, but yeah, it would serve as a highly compounding portion of your hedge, is the way I would think about it. So if the VIX is trading down at 13, and then you buy, let's say, we could look at the VIX right now, and so if we go out 238 days and you buy some teeny options that are down at like 10 delta or 50, you're gonna pay what, like a few dollars if that. But if you get the move that we're trying to protect against, those obviously compound very quickly. So they can, in a big move, they can actually really enhance your overall hedge. But to your point, I still think the primary portion of that hedge is going to come from the deep in the money because that's going to move dollar for dollar faster. So whenever I'm hedging with something like that, I almost always add the teeny options because they're cheap enough, and if you can get the compounding, they pay for themselves for the next 4 times you run them. But yeah.
And then for our viewers, if you were going to trade the future, I believe that you would have to trade /VIX. And if you were going to buy the option, I think that the preferred way would be to trade VXX. Is that accurate or am I incorrect?
So for VIX futures, it depends on your platform, but for like Thinkorswim, it's /VX, not VIX.
Okay.
And then for options, you could use VXX or you can use VIX. It really depends on your preference between the product tracking. I think I've had good success with both of them. The other thing you can do that I've gotten kind of cheeky with before, and if you want to be efficient, is you can use a levered ETF. The downside
Like
of that is
UVXY or SVXY?
exactly,
Yeah.
exactly. The downside of that is there is drag,
Yeah.
but the drag on those returns, it's so overplayed by people that completely write it off as you can't ever hold these for longer than a week because the drag is so bad. And it's really not. That drag simply materializes as tracking error. So if it says as if it's, 3 times levered, the move you get is like 2.6 times, not quite that 3 times. That's the drag you see.
So
So
I think
yeah, just another way to do it.
for UVXY and SVXY, I think they actually like reconstituted or recalculated it on like February 5th or February 6th, like 2018. Because I
Oh, I
remember
see.
I was flying to Cartagena, Colombia with my wife, and then those like I forget whether it was UVXY or SVXY. I think it was SVXY. It basically like blew up. It went from like 140 to like 12 in like an afternoon in like 4 hours.
Visit beststockstrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and review. If you have any questions, visit beststockstrategy.com and send me a message.